Chapter 3, Part 1, Job Costing versus Process Costing and Manufacturing Overhead. Now, job costing, this is what we're going to cover in this chapter. Unique custom order products like a boat or antique car company, relatively small batches, or fancy jewelry. Each unique product or batch is separate job. Another example would be a landscaping company would use job costing. Examples, airplanes, customer home builders, high-end jewelers, accounting firms, and law firms. Now, process costing is when we have mass production, the units are identical. Through a series of uniform production steps, processes, average manufacturing costs across all units produced. This is what we're going to focus on for the rest of the chapters. So, flow of inventory through a manufacturing system. We always start with raw materials. It then goes to work in process, then to finished goods, and then to cost of goods sold. When is manufacturing overhead allocated? When it's in WIP, work in process, because that's when it gets direct material, direct labor, and then we allocate the overhead. Then it goes to finished goods, then it goes to cost of goods sold. Overhead. Now we have to understand all the terms because this is just really, really important if you're going to try to come up with overhead. You need to know all the terms. Now, we have an annual estimated overhead cost, annual estimated activity base. These are what you have at the beginning of the year. They are estimates. With these estimates, we come up with a predetermined manufacturing overhead rate. Then we have the actual overhead costs. We have the actual activity. Then we have the year-end actual overhead costs and the year-end activity. Now, here's what we do. For these are used to estimate the predetermined manufacturing overhead rate to be applied at the beginning of the period. The overhead rate that is applied throughout the year is based on actual activity. So we come up with a rate and then we apply it based on actually what happens. Actual overhead costs are collected in an overhead account. Actual activity, this is the basis for applying the predetermined manufacturing overhead rate to work in process, which is where we apply overhead. And the year-end actual costs and year-end activity is going to be used to determine the actual rate and whether we're under or over applied, which is the difference between how much of the cost we apply based on the predetermined manufacturing overhead rate and the actual costs for overhead. Now let's look at a problem. So we have estimated annual overhead of 120. We have estimated annual machine hours. Now, these are three different ways that you can allocate overhead. You can use machine hours, direct labor hours, or direct labor dollars. You can only use one. You cannot use all three, but I'm going to show you how you would do all three. So for the month, we had actual machine hours of 60, direct labor of 540, and direct labor dollars of 8,100. So how do we figure out how much would have been applied? So step one, we estimated the total manufacturing cost for the coming year. We've already done that. We said we think we're going to spend $120,000. Step two, we select an allocation base or cost driver and estimate the total amount. Now, we came up with three. Remember, you're only going to use one, but I did all three so you can see the difference based on which allocation or cost driver you decide to use. So, for the year, we have estimated annual hours. These are all our estimates. So now we can come up with our predetermined manufacturing overhead rate. So, first, we're going to take the total estimated annual manufacturing overhead divided by the total estimated annual amount of the allocation. So if we were going to do it based on machine hours, it would be $60 per machine hour. If it was based on direct labor hours, it would be $10 per direct labor hour. And if it was based on dollars, it'd be 120% per direct labor dollar. Now, let's allocate. So to allocate, we're always going to take our predetermined manufacturing overhead rate times the actual amount of the cost driver. So for a machine, we would have applied 3,600. If we had used direct labor hours, we would have applied 5,400. And if we had used labor dollars, we would have applied 9720. So remember, you can only use one, but you certainly get a different amount based on what you use. So you really have to give that a lot of consideration. Now, since we are using an estimate at the beginning of the year, we're estimating how much we're going to spend in overhead and how much we're going to have in terms of the cost driver, we always end up with being under or over applied because manufacturing overhead is allocated using an estimate. It's applied based on actuals. So you're going to be either under or over applied. Under is your actual costs are higher than the amount you've allocated. Over applied, your actual is less. Now, neither one of those are good. You want to get as close as possible. And the reason you want to get as close as possible is because you're using this information to do future estimates. So here's an example. This is the estimated overhead cost and the actual and the estimated manufacturing hours and the actual machine hours. So we used our estimates to come up with the rate, and we'll use our actual to figure out are we under or over applied. So our predetermined overhead rate based on our estimated overhead cost divided by estimated machine hours is 1175. And how much was actually applied? 264,000. The overhead is over applied because we applied $20,000 more than we should have, which means that we have overestimated the costs, and cost of goods sold would be credited at the end of the period because overhead does not appear on the financial statements. Now let's analyze overhead. Do another problem. Okay, here's a company. We use a predetermined overhead to allocate overhead. At the beginning of the year, this was our total estimated overhead cost, our estimated direct labor cost, and our estimated machine hours. Now we had actual activity during the year. So first, let's determine what's the predetermined overhead rate and how much was allocated. So first, we're going to take the 610,000 divided by our estimated cost driver, which in this case was machine hours, and we get a predetermined manufacturing overhead rate of $8. So we're going to take that times the actual machine hours, and we allocated 444. Is it under or over applied? Well, our actual overhead was 497. So we're under, let's see, we are under applied by 53,000. That means that we're going to add more to our cost of goods sold. That's never a good thing. All right, so what if we'd used direct labor hours to allocate instead? Well, our rate would have been 41% of each direct labor dollar. We'd be more under applied. So what about non-manufacturing costs? Sorry for the background noise. Now let's look at some slides, kind of help you see how all this costing is done. So we're going to use these terms. A cost driver is an activity that causes a cost to be incurred. The purpose of job costing and process costing is to determine the cost of a product. Kia manufactures autos. It would use job costing. Cost allocation procedures distribute accumulated indirect costs to the program or service that benefits the costs. Job costing is used by companies that have unique products. Process costing is used to average the cost over similar products. And process costing is used by companies that produce large numbers of identical units. That concludes part 1.